Islamic trade finance. Islamic teachings provided guidelines for Muslim nations to set up their economies and infrastructure. This system was different from Western economies, making it difficult for them to collaborate. In order to overcome some of these differences in the world of finance, around the year 1950, Islamic trade finance came into being. Islamic trade finance is administered in a manner that complies with Sharia laws and teachings. To help support Islamic trade finance, the International Trade Finance Corporation, or IFTC, was established in the year 2008. The purpose of this organization was to aid countries such as Bahrain and Saudi Arabia in adopting the practices of Islamic trade finance. It does this by providing them with the necessary tools to compete in the international market and develop methods to provide banks with incentives to partake in the system. The fundamentals of Islamic trade finance. Based strongly around morals and religious belief, Islamic trade finance products avoid the involvement of riba or interest, which Sharia strongly prohibits. In order to systematize international trade to an Islamic economy, several credit techniques have been developed to substitute the role of interest within transactions. Murabaha is one of the ways Islamic trade finance organizations incentivize banks whilst remaining within the limits of Sharia. It is the amount which becomes the bank's return when that good is sold to a customer for payment at a later date. With both the buyer and seller agreeing on a specific profit margin added to the cost, this is not seen as interest. Rather, it is a technique of profit and loss sharing. Here's a look at the 6 key differences between conventional and Islamic trade finance. Number 1. Islamic trade finance is in compliance with the principles of Islam. On the other hand, conventional trade finance doesn't consider any religious principles. Number 2. Islamic trade finance does not involve the role of interest, whereas regular finance heavily relies on an interest-based environment. Number 3. Sharia-based trade operations may be financed through profit and loss techniques, whereas conventional transactions are financed exclusively through credit. Number 4. Islamic trade administers techniques of profit and loss sharing, while conventional transactions almost always involve interest. Number 5. In Islamic trade, both parties decide on the profit margin, while in conventional trade, sellers primarily decide on the profit margin. Number 6. Islamic finance uses mudaba, ijara, and diminishing mushaka to incentivize sellers and exporters. However, the conventional system uses interest-generating opportunities to incentivize banks. Number 7. The Islamic system is mostly practiced in Muslim countries, whereas the other system is practiced worldwide. Islamic trade finance products. Islamic trade finance provides a wide range of tools and instruments which regulate how cash, credit, investments, and other assets can be utilized for trade. Islamic trade finance products includes the following: letters of credit, trust receipts, accepted bills, shipping guarantees, working capital financing, and export credit financing. Forex trading in Islamic finance. When it comes to transactions in foreign currencies, Islamic banks tend to exchange these currencies on the spot. Forex transactions may be taken on by several Islamic banks on the basis of contracts or currency arbitrage. While Islamic banks incorporate a profit margin into the contract or transaction, they stick to their values of profit-loss sharing.